advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome. This is Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, and my office is Asset Management Resources. We're a registered investment advisor firm, and our show is a financial show. We call it Something More because we like to talk about not only those important dollar and cents issues, but also those quality of life issues that make the money matters matter. And we've got a lot of show for you today. We're going to, let me start by introducing, I've got Cathi Ingersoll with me, our marketing director. Thanks for being here, Cathi.
Glad to be here, Chris.
Jeff Jeff Perry, who's off and on, has the day off after he's been covering for me for a long time, quite a bit. So good for him to have a little break. In any case, he'll be back next week. Is next week our Easter show, or is that the week after? I'm losing track. That's the week after. So anyway.
That's a week after, correct.
But he'll be back next week, I think, with me. I'll be here next week as well.
Yeah.
So there we go.
Yep.
Getting confused which one's which. But in any case, glad to have you with us. By the way, if you don't know, if you're listening in the car or something and you're moving around, you can pick up the show through the iHeart app, which has a streaming service. You can listen to WXTK at 95.1 FM. Or if you don't get to listen to the entirety of the show, we post our podcast of our show routinely, and you can catch that on pretty much anywhere you like to listen to podcasts. In addition to the iHeart app, you can listen to it on Spotify, iTunes, Amazon, pretty much everywhere. So in any case, let me tell you a little bit about our plan today. It's spring, Cathi.
Can you believe it already?
Welcome to spring. Yay. And we had daylight savings time. We've got now spring has sprung, so to speak. So, we're getting to the season that we get longer days, and I really like that. And hopefully we start to get warmer days. And we do tend to have a lot of rain this time of year, but hopefully it starts to ease up for that. We have spring flowers.
Yeah, and it's nice to leave work and not have it be pitch black at 4 o'clock.
Exactly.
Not that I leave work at 4 o'clock, Chris.
No, but at 4 o'clock, right? Yeah, when it gets dark so early. So in any case, hopefully there's a little bit of encouragement, enthusiasm. I think, springtime. We were talking about Easter a minute ago. All these are the season of new beginnings, and it's an encouraging time of year to sort of reimagine. What are we focused on, And you
mentioned our Easter show. We have a special guest that day.
We do. We'll have Pastor Ben Feldot joining us.
That will be an interesting show. And then the week of April 22nd, we've got a live show with Marcia Mantell focused on FDA, or focused on Social Security.
Social Security coming up. So who doesn't like that? And we'll have plenty of opportunity for callers to participate and join in, get answers to your questions. What date is the Marcia Mantell, the Social Security?
That's the 22nd of April.
So coming up. So in any case, hard to believe how that's still a month off. But by the way, that same day happens to be Earth Day.
That's right.
Which caught my attention because I happened to catch a headline in doing some scanning of news during the week, and this was pretty grim. It was the idea that climate change is upon us, and the UN panel had basically said we have about 10 years before we reach a catastrophic climate change conditions. I don't know. That sounds pretty severe, pretty grim. Sorry, everybody. That's bad news.
From what I read, it meant a 2.7 degree increase Fahrenheit.
Yeah.
Now that doesn't sound that much.
Decade is expected. Yeah. No, it doesn't sound like that much. But if you factor in what impact that has when it comes to the oceans and some of the consequence that has on weather, it can really add up.
I think I had been to a presentation
and
2 years ago where there was an expert on this topic speaking, and he said, it's really going to change the geography of where people live. Like, think of Florida, which is
pretty flat
sea level, right?
Yeah.
If the sea rises there,
just because the degrees rise a little bit, and there's that much more ocean instead of ice.
yes.
Right. Yeah.
So anyway, they predicted a lot of impact from that, like that people live in Florida, the wealthy people are going to be moving to the Midwest, and, Florida people that don't have that wealth and ability to relocate will be staying in more it's
going to be water world.
The water world.
Do you remember
Kevin Costner,
right?
Yeah,
we're going to be watching that. I don't know. Well, anyway, a little grim, but it caught my eye just because you can't, oh, by the way, you have a decade. It's kind of really before things get more severe. In any case, I'm sure we'll be talking about that if things do really come to pass. But as far as how this plays out and if it's an ongoing, I guess it's continuing as an ongoing concern for people. Not
Sure.
everyone is on board as considering this a human caused development, but I think it's something everyone probably needs to be attuned to in case there is some worry about things like you're just talking about with Florida.
Think of how much that would change everything, right?
The economy. I think weather, you can't help but look at weather lately and say, is there something changing? You know what I mean? When it comes to fires, floods, fill in the blank, you know what I mean?
And you don't know if it's an anomaly or I think you have to look at trends, right?
Right.
To see. But yeah, California certainly had their share of bad weather this year. We had a very mild winter.
Which is great.
Massachusetts,
Yeah. So, as far as our show today, Cathi on our notes dubbed it doom and gloom.
Yeah.
Sorry, everybody. We're going to talk a little bit about what's been happening with the banks, of course, and inflation with the Fed. We'll have Brian on in just a little bit, talk a little bit about that. Brian Regan, our firm's chief investment officer. I wanted to think in terms of, too, like some of the anxieties people have is around like all these banking, issues. Well, naturally there's the what if something happens to affect my access to my brokerage services or things like this. So we want to kind of help people get a little bit of comfort around these, scenarios that are probably unlikely, but just so you get a sense of what do you pay attention to? How should you protect yourself? What are some of the things you can do in this regard? So, and then in the next hour, we're going to talk about a variety of things, but one of the things that we're going to talk about is some recent news about a local financial advisor who's had some challenges where they've been charged with the SEC, and we'll talk a little bit about some of the potential for wrongdoing, how you as a consumer can be mindful of these kinds of risks, and what to pay attention to, and thinking about how to be looking out for your interests and how to find people that can help you and give you the best odds for having less risk.
Right.
You know what I mean?
Sometimes
less worry of fraud or things of that sort.
You do have to be your own best advocate, right? Whether you're going to the doctor, to the financial advisor.
You
but
still
you also
have to be your own advocate. Exactly.
And but with that comes being educated about what types of questions to ask
and ultimately
what to look out for.
We look to professionals because we trust them. We're looking for their guidance. Whether it's the doctor or if I go to the doctor and I need their expertise. So you really do. There's a lot of trust you put into whether it's in that case the physician or in our case a financial professional. There's certainly an opportunity for a violation of that trust, and we want to try and just talk a little bit about things that you should be tuned into so that you're your own best advocate in the process and trying to align yourself with opportunities to avoid problems. That being said, it seems like you would have thought the same of the situation that we'll talk about in the next hour. So it's challenging. In any case, and who knows what else, lots of other things. So let's do this. Let's take our break. Let's bring Brian Regan in. And, Cathi, you wanted to remind everyone about our survey, though, didn't you?
Absolutely. So we do have a place on our website, amrfinancial.com, on the radio page. And we have a survey up at the top. We'd love to have you just take a few minutes, answer a few questions there. Tell us what you want to hear about on the radio program. What do you like? Where do you think there's some opportunity? Maybe things that you don't like so much, so we won't focus on them quite as much in the future. But what do you want? What do you want to hear about? I mean,
climate change, perhaps one of those. I'm just teasing.
That hasn't been on there yet. But
so you can go to somethingmorewithchrisboyd.com, or you can go to amrfinancial.com/radio.
Yes,
and you'll get to the same location. And appreciate your input on that. Love to hear from you. By the way, if you have a question ever, you can always send us an email, radio@amrfinancial.com. That's radio@amrfinancial.com. If you have a question, a topic, anything you think we should be diving into, we'd be happy to address it there as well. All right, with that, we're going to take a quick break. We'll come back with another segment right after this. Welcome back to Something More with Chris Boyd. We're joined now, again, Cathi Ingersoll is with us, our marketing director, with me throughout the show. I've also got Brian Regan, our firm's chief investment officer, and Scott Birmingham, our lead financial planner. Thanks, guys, for being with us. Thought we would talk a little bit about the news of the week with the financial news, particularly as it relates to the Fed to start us off. Over the last couple of weeks, we've all been focused on what's been happening with the banking system and the response to that. We'll talk more about that over the next segment or two as well. But naturally, that fed into concerns or questions. How is this going to affect the Fed's decisions about whether or not to raise rates? It had seemed pretty implied that the Fed was going to raise rates 0.25%, maybe even 0.5% before this whole banking thing came about. And now sort of the question was what would happen. So Brian, Wednesday, Federal Reserve met, and tell us all about what happened.
Well, they raised quarter a point or 25 basis points, basically in line with what the market expected. Jerome Powell in the press conference was asked if he considered pausing rate hikes, and he said that it was definitely under consideration by the FOMC. But they decided that the banking system seems well supported by the moves that they've made, and that he was a little concerned with the more recent inflation data that we've had recently. So that's what led them to continue to hike. They also opened the door to either stop hiking in the next two meetings or in the next meeting by their statement and their language. They before they had they expected ongoing rate increases, and they took that language out. So they opened the door to pause in the next meeting. He did go out of his way to explain that he expected credit to tighten based on what's going on with the banks. This is something that we've talked about in last week's show.
Yes. Probably bears repeating a little bit, do you think?
Yeah, and he acknowledged that he thinks that's going to happen. The question is, what magnitude is it going to happen? I've seen high yield spreads go up about 1% since this happened. So you can, if you want to put some kind of methodology around how much tighter it is, it's give or take. It's like if the Fed raised 1.25% rather than 0.25% in the last week, which is a big change. Credit tightening is very important, and credit is the lifeblood of the economy. So these are all very disinflationary moves that they're making.
How does this manifest itself?
Initially, the market sold off dramatically.
How does this manifest itself, credit tightening, when if a small business is looking for access to credit, is it through the local bank that they're having, this, you're describing this, you talked about credit spreads, but, talk about how it's going to manifest for access to capital and the cost of that capital.
Yeah, so I think credit spreads are a great gauge of the economy as a whole, particularly the high yield spreads, because most businesses aren't S&P 500 companies that can borrow at investment grade rates. We're seeing mortgages, for example, go much higher more recently, despite the 10-year Treasury rallying. You would think if the 10-year Treasury rallied, then mortgage rates would go down. But the cost of capital is higher. Banks are demanding more to make these loans. So that's one real world example. If you're a small business and you're looking for a loan, you typically need to post collateral. One thing that might happen is you might have to post more collateral, or the loan that you get might be smaller. The loan they're willing to make might be smaller based on the collateral that you're willing to offer. The rates might be higher. Typically, banks like to do floating rate loans for the reasons that you saw with Silicon Valley Bank. As deposits go up, you really like your asset base to also pay a higher interest rate. So, most construction loans, most home equity loans, if you borrow against your stock assets, these are typically floating rate loans that are subject to change. There's a variety of ways that credit can tighten. They can demand higher quality borrowers. They could demand higher collateral requirements. They can just raise interest rates, or they can just decide they want to make less loans and hold more reserves. All this is ways that the people on Main Street, quote unquote, will see this tightening.
And Brian, I imagine companies therefore might not have access to, a fixed loan where that may affect a capital project that they were going to implement, maybe real estate development. And then what about working capital lines of credit? Well, I assume may affect that as well. So could it affect a company's inventory and their ability to produce goods?
Well, let's talk about specifically about working capital credit. These are typically called bank loans, and I want to talk about them specifically because we were investing in them for maybe a couple of years. Did very well. Typically floating rate, like I mentioned. The collateral for these loans is typically the inventory and the accounts receivable of kind of a mid to small size business. And I sold them for the exact reasons why I just mentioned. There's a few things that might happen, right? They might be out. The bank might demand that the borrower needs to post more collateral, meaning they need more receivables, they need more inventory for a certain level of bank collateral. They could cap. This happens pretty often. They could cap how much they're willing to lend, even against good inventory. So that would mean a business, in order to build new inventory, would have to use cash flow. They might have to sell their inventory, which usually means a haircut for the company. All these puts more strain on companies. There's no doubt. It makes defaults more likely. It makes layoffs more likely. This is why we say that credit is the lifeblood of the economy. There's a whole bunch of knock-on effects if credit is unavailable. I think like you mentioned, real estate development. It's no coincidence that mortgage applications and the price of a mortgage are very highly correlated. As the mortgage rate goes up, there's less mortgage applications. If there's less mortgage applications, the price of homes is gonna falter. I read something yesterday that the national average is down 14% from its high, and I think it could still reasonably fall lower. And what does that mean? Well, if your price of your home falls, so you can borrow less on your home equity line of credit, for example. That if you borrow less in your home equity line of credit, you might not, build that addition to your house. That the carpenter that would build the addition doesn't have a job. There's I can go on and on and on for days and days about the effects of slowing
So
amounts of
ultimately,
credit.
it's a slowing effect, and therefore reduction in the pressures of inflation is ultimately your point. You had, before I interrupted you earlier, you started to move on to talk about market response to maybe the Fed's recent decision. Tell us a little bit about that.
Yeah, so it was interesting. When the announcement initially came out, the market rallied. During the press conference, it seemed like the stock market was doing fairly well. After the press conference, from 2:30 to 4, it felt like a stone. Trying to trade the stock market on a Fed day, good luck to you. It's a roller coaster typically. And then the following day on Thursday, it rallied, very significantly, and made up all the losses, at least in the morning, that it had on the Fed day. So, once again, stocks are long-term assets. Let's not concentrate too much on a couple days.
The bumpy
or a week.
ride from day to day, huh?
Yeah. One of the things that I've been pointing out to you guys on the Monday meetings that I think is very important is the long-term, the 3-year returns of the stock market are staggering. If you just look at the S&P 500, you're close to 90% over the last 3 years, and you almost doubled your money. In our last webinar, I talked about how I would expect the stock market to double over 10 years, but we've almost had that over the last 3 years. Year to date, we've done very well. Over the last 6 months, we've done very well. The bond market, we talked about having quote-unquote groomed slopes for the bond market, and so far in Q1. And so far, knock on wood, that seems to be the case of what's happening here in Q1. I think there's a lot of negative sentiment, and I actually looked up the bullish sentiment indicators, and only 19% of people surveyed are bullish, which I think is unbelievable for a stock market that goes up 80% of the time. So there is an overwhelmingly negative sentiment, and I understand we haven't reached the high water mark that we had in these markets, but there's been a decent amount of time that's gone by where we, the low seems to have been put in. The fixed income markets seem to be negatively correlated with the stock market again, which is nice. We're getting higher yields. I'm just saying there's reason to be optimistic, despite these bank failures, despite the regular negative headlines that come out every day.
You mentioned it early on when we just at your initial comments, but I think it's probably worth repeating, even though we've talked about it last week and people may be somewhat familiar with it. But in the face of recent bank anxieties, the Fed and the Treasury did develop some special measures to try to ease anxieties for both depositors and for banks in how they might deal with current environment. Maybe it's worth just a quick revisit of that before we take our next break.
Yeah, so the FDIC did, basically their routine thing where they go into a failing bank and they take it over and they insure deposits, typically over up to $250,000 per account. This time they did it across all accounts, which was important because, for Silicon Valley Bank, I think over 90% of them were not
were greater than the FDIC insured,
So that should give a little confidence to the system that the FDIC, worked even better than we could all have hoped and did exactly what they were supposed to do. The reason why Silicon Valley Bank failed is because of a mismatch between its assets and liabilities. This is a very basic part of banking. They took too much risk further out in the curve, took too much interest rate risk, basically. And the Federal Reserve solved that really with a swipe of a pen, where they said that they would lend up to 1 year up to par on collateral. So if you own a Treasury bond and the market value of that bond is 87 cents on the dollar, they are not going to lend just on that 87 cents. They'll lend all the way up to $1. So that was a significant difference. It essentially brought the duration of those longer term bonds, down to zero, and there should be no issue with, banks that are overextended on treasuries meeting the depositors' needs, even if they are making runs on the bank.
It sounded like a pretty significant amount of funds had been borrowed in making use of this facility. Does this tell us anything or mean anything as it relates to the future anxieties of the banking system?
I think that remains to be seen. I think banks did the right thing where if they were extended too much, they right-sized that. And I think what we have seen recently is a kind of easing of those concerns over time. I don't necessarily think that's surprising. I don't know if it was last week or the week before. I think my exact words is that the federal government did the exact right thing, and I think behaviorally people haven't latched onto that yet. But with a little bit of time, that will be the case. And I think that people are starting to understand that the banking system isn't just because Silicon Valley Bank failed because of complete lack of basic risk management. Doesn't necessarily mean that's going to be the case for the entire system.
All right, excellent. I think just to before we take a break, let's talk about the idea that people have their own investments. Maybe people have bank investments. They might need some counsel as to whether what they have is something they should keep or not. I would just mention that if you do have questions about your portfolio and whether or not you're positioned well, or maybe there's things you want to consider doing, get some counsel. And if we can be of help in that process, we do offer a complimentary portfolio review. Complimentary consultation. We seasonally do the other. But anyway, if you want to get a little bit of second set of eyes on this and we can be a resource to you, reach out to us through our website, amrfinancial.com, or give us a call at 866-771-8901. Brian, I'm sure you'd be happy to help people if they have particular questions about their mix to see if we can give them good counsel.
Of course.
Absolutely. All right. So when we come back, let's talk a little bit about the FDIC. What are those details that people should remember? Let's also talk about what if my institution fails? What happens logistically? And I'm thinking not just banks in this case. I'm thinking like if I have a brokerage account, what do I do? How do I get it? Okay. So we'll talk a little bit about some of these kind of things. We'll be right back after this. Stay with us. Welcome back to Something More with Chris Boyd. You're here with many of our team members from Asset Management Resources. Thanks for being with us throughout the show. We are talking a little bit about financial conditions. A lot of the worries about the banking system has been on people's minds. Feels as though the Fed has been pretty effective in trying to address a response that should mitigate some of the kind of problems that we're developing with SVB and some of the other banks that they jumped in on. But at the same time, it's a cause for concern. We didn't actually talk about one of the other banks this week. Brian, I probably should start with that. There was news with Credit Suisse this week. That was kind of a different scenario, a foreign bank, really. What happened there, just in brief?
In brief, Credit Suisse failed, and the Swiss government orchestrated a sale of Credit Suisse to UBS, not dissimilar to how J.P. Morgan was strongly encouraged to buy Bear Stearns back in the financial crisis. Okay,
so in any case, now one of the systemically important global banks, UBS, now is even bigger. Is this create any kind of risk for some of these issues we dealt with in 2008, or is this something altogether different?
I don't see any risk so far. It doesn't mean that there's not something that
that we're not privy to,
that I don't see, and that might come out later. But I think that if there's anything good that came from the financial crisis, there's a bit of a playbook on how to deal with these things, right? I said kind of jokingly or facetiously, just like J.P. Morgan was strongly encouraged to buy Bear Stearns. Well, that, if you read any history about that, that was not an easy thing to do. It was a lot of arm twisting. J.P. Morgan didn't really want to do it. But it got done. It got done with some time, with some anguish, with some turmoil in the markets. Relatively speaking, this seems like it was less painful. It seems like UBS was able to kind of
Yeah.
dictate their terms and get the job done,
It
without a lot of anxiety.
it also seems like Credit Suisse's problems have been forecast for a long time. This was not something new, related
Right.
to recent activities with some of these other banks. I think this
Yeah, there's a 15-year, at least 15-year,
in the
downfall
making.
of Credit
Yeah.
Suisse, for lack of a better word.
Yeah. And there were a lot of regulations, to your point, Brian, that came out of the 2008 bank failures that have corrected some of the problems from potentially happening again. I think, what is it, Frank
Yeah,
Dodds or whatever
Dodd-Frank.
that.
Well,
Dodd-Frank
that raises an interesting point. There's been a lot of discussion about some of the rollback of some of the Dodd-Frank reforms that affected banks like SVB.
That's true.
And is that something that's likely to be re-revised, or what's going to happen with that? Either of you might have some
I don't think
insight.
anything's going to happen to it
Yeah.
with a split Congress.
Yeah.
Yeah. True.
If Congress is involved, I think for the next couple of years you can sit back and just kind of laugh. Nothing's going to happen, right? My laughter stopping at the debt ceiling, because it's obviously a
Right.
concern that
Well,
nothing
is
will happen
that
there, but something should obviously very much happen.
does that create concerns for those banks that are between 50 million and whatever it is, 200, 250? I forget the
200. That's,
that don't have the same rigorous requirements for testing.
Does the bank
This recent
debt ceiling?
the rollback of the Dodd-Frank rules that somewhat is argued to have helped to participate in the permitting the SVB to be in a position where things fell apart.
Yeah, I mean, from
The
what
lack
I understand,
the
what
lack
happened
of
with
stress
SVB
testing.
From my understanding, what happened with SVB, that this would have nothing to do with Dodd-Frank. I know that is like the political football that the Democrats want to use right now, but this, I can't stress enough. This is very, very basic risk management that they failed to do. What the protections of Dodd-Frank do is try to make sure you don't take too much credit risk for the most part. This wasn't a failure of credit risk. This was a failure of interest rate risk, which is very basic. So, how banks should make money is they should match their interest rate with their liabilities and then make a small spread based on, intelligent credit analysis. They failed on the first part of that. That story, which is very basic, something that should never really happen. So, I'm not an expert on Dodd-Frank, but what I'll say is I don't think this is a regulatory thing. I know everybody wants to jump to politics these days, but this is, as simple as it gets when it comes to something that shouldn't have happened.
and Brian, you brought up a good point earlier in the week when I was talking to you. It was the SVB, the bank entity, that failed and was taken over. There were other subsidiaries of Silicon Valley Corporation that are still operating as entities, like SVB Securities and SVB Capital.
Right. So SVB Capital is basically a private equity firm, and forgive me, I don't quite remember what specifically SVB Securities does. But yeah, they're separate. They're separate from the bank. They are all under the umbrella of the Silicon Valley Bank Financial, or SVB Financial, parent company. And this was actually fairly controversial this week. You might have noticed that the FTC seized $2 billion worth of cash that SVB Financial, the parent company, had with Silicon Valley Bank. I was personally kind of perturbed by this because I think it may be an illegal seizure, because that money may belong to the bondholders of SVB Financial. But that'll be litigated with time. But when you go through the bankruptcy process, for example, SVB Capital and SVB Securities are viable businesses that are operating, and they're gonna be sold, out of bankruptcy to some other bidder.
So let's talk a little bit about extending this beyond the banking system a little bit. Well, before we do, let's talk about what are the current protections. We've talked about FDIC insurance. What should be the kind of numbers people keep in mind? How does FDIC insurance work at its rudimentary level?
I worked for a failed bank. I'm not proud to admit it. No, but
Yeah. At one time,
I worked for
you were in the
Fleet-
banking system
Fleet
for many
National
years.
Bank. Correct. And Fleet National Bank failed and was taken over by the feds, and it was pretty much business as usual. It did not affect account holders unless they had money over and above the FDIC insured limits. But basically, the feds came in, they operated the bank. There were some senior management people and things that were let go, but the feds came in, operated the bank. They found a match in it was actually Bank of New England that I was working for, Bank of New England.
Oh, yeah.
They found a match with Fleet National Bank, and Fleet National Bank came in and took over the operations at that time. But like I said, it was pretty much business as usual. Now, the FDIC, though, does insure deposit accounts. Excuse me.
So that's checking accounts, savings, CDs, things like that.
Exactly. Money market demand accounts, money market deposit accounts, up to $250,000 per entity, per account holder per entity.
So for an individual, that's one. For a business,
that may be a second. It depends how the business account is filed.
Yeah.
I'm not a legal expert.
No, we're trying to get
Chris,
but then that's different from a joint account, which
correct.
would then have distinct. In that case,
could potentially
$500,000
could potentially be covered at the same financial institution for more than $250,000, depending on how the ownership of the accounts. Correct, like a revocable trust or a personal account or a joint account or a limited liability account, and over and above that, I don't know. I think the guidance at that time was, if you're over and above that and you're not covered past the $250,000, open an account at another financial institution to get that coverage. But you do, Chris, I just wanted to say one thing. You do have to do a little investigative work and make sure you are banking with an FDIC insured financial institution, because not all banks, credit unions.
Yeah, so they have a similar type of entity. It's slightly different. It's designed for credit unions, but similar kinds of levels and so forth. But what's that? The National Credit Union Administration or something.
That's right. That's right.
So, but that's similar,
Right.
But do you have FDIC insurance? And some places do not, right? Some do not have federal, let's put it that way, federal insurance.
Correct.
And that's what you want to be careful to, make sure you do have.
There are nationally chartered banks, which the big name banks are all nationally chartered. There are state chartered banks, and most of the state chartered banks have FDIC insurance. They're under the FDIC program. But there are some state chartered banks that are not FDIC
protected
member banks, and so they don't have that protection. I can't say what their protection is. I just don't know.
They might have something, but is it is it back to the same level, the same way, the same levels of protection, the same stability that you'd expect from this? The other thing I was going to say is some banks have supplemental insurance that they purchase. But by and large, I think the point we want to bring home is if you have more than these limits in a bank, a couple of things to consider. One is, do you have too much liquidity in the bank? Do you that may be too much, missed opportunity for investment. Sometimes, like, on the other hand, if it's a business that has different cash flows moving in and out, well, that's a different story, right? But if you're an individual and you have more than $500,000 between you or a joint account or whatever, that might be questionable whether you have too much anyway, just from a long-term planning point of view. Secondarily, it may be a question of, if you do, would it be prudent to spread it over more than one bank? Some of the recent efforts have sought to prevent people from having that anxiety, but I still think it would be probably prudent to think along those lines and move funds so that you're not overexposed.
Yep. That as a short-term fix, I think certainly seems like a logical approach. But like you were saying, look at the big picture of your financial story, right?
Right. Right.
Is that where you want, do you want $750,000 sitting in a 1% interest
or
account
whatever it is, right?
At a bank.
So that's one issue. Let's talk about another issue. Let's talk a little bit about how investors in brokerage platforms have protections in the event of a brokerage platform having challenges. I don't know who wants to jump in on this, but we talk a little bit about SIPC coverage. Cathi, do you want to keep doing it, or Brian, Scott, either of you guys want to jump in? You guys up on this stuff?
Yeah, sure. So I'll do it. The SIPC Corporation, which stands for Securities Investor Protection Corp, protects customer security accounts up to $500,000. So that's nice. You get a little something similar to FDIC insurance. But most importantly, I think it's important to note that the brokerage firms typically have your assets custodied in your own account at a third party. For Schwab, it's actually held at Bank of New York, or the majority of it's held at Bank of New York, and under your account. So it's not the bank's assets; they can't access them, they can't use them to pay off their own creditors. It's yours; it will be yours, and I think that's a very, very important distinction.
It is. I want to just
it's not going to disappear with the brokerage firm.
Yeah, it is very important. It's not their creditors' access to that money. It's distinct. But just to clarify a little bit before we dig further in, you said that SIPC protection is about $500,000 for each separate legal entity, as the way you were talking about it earlier, Cathi, with FDIC, right? But there is a $250,000 included in that limit for cash. So if you have in excess of $250,000 on account, that could be distinct. In some brokerage accounts, though, they also have an FDIC insured account. So it could be that also has protection over and above what is referenced in the
brokerage part of that investment.
Yeah, exactly. So in any case, that's one thing. And similar, I would also point out that most brokerage platforms also have protection that there's private insurance beyond the SIPC coverage, so that they have, many millions of dollars of coverage for each account. The thing I'd like to clarify, though, is what does that cover? So my account went down. Do I file a claim with SIPC?
No.
Right. You know what I mean? It may be obvious, but just to, reinforce this stuff. What's the kind of thing that this would cover? What are the kinds of risks that this protection provides coverage?
Well, it's really the protection of your assets in case the brokerage account failed and for some reason they weren't backed up appropriately, which they typically are.
Yeah, or I would say fraud. If there was a rogue employee or something that did something improper, that the consumer is protected from some undetected shenanigans that otherwise would be prevented by the brokerage platform, that kind of thing, right?
Right. And I think it's important to know, Chris, and I think you know this week you were pushing on this, and I asked Schwab about it specifically. I said, if this were to happen, what would take place?
Yeah, logistics. How's it
and
work?
they just said, hey, look, we don't expect if this very rare event were to happen, and the brokerage firm is separate from the bank. So if you're thinking about Schwab Bank versus Schwab brokerage, they're separated, just like we talked about SVB Capital was separated from SVB the bank. So just because one goes down doesn't mean the other one doesn't operate. But what they said was that we wouldn't expect it to go black. And from my own experience working in defaulted companies, that's the case, right? They continue to operate. They get something called DIP financing, which is called debtor in possession financing. The company continues to operate through the bankruptcy process until they get bought by another bidder, and then they're just owned by another company, and the brokerage assets would likely move over to a different
brand or whatever, whoever's going to operate
parent firm.
Right.
But other than that, we wouldn't expect.
I think that's really important for people to just understand, and I wanted to, in the face of these kinds of anxieties, I just wanted to address that for people, that there are these kinds of processes and systems, and how much worry should people have? Most of these kind of situations would be a temporary disruption in the midst of that initial trouble, whatever it would be, whether it's a bankruptcy or something like that, and then the replacement very quickly thereafter. So anyway,
it would be pretty much business as usual. That SIPC would come in, take over the business, keep running it until they find like Brian said, until they find another broker to take the business over.
So in any case, I hope that's of some comfort to people listening. Listen, if you have any questions about anything that you're dealing with your financial matters, whether it's your financial planning or your portfolio management, we here at Asset Management Resources welcome the opportunity to try to be a resource to you and to be of help. If you'd like to take advantage of that, reach out to us through our website, amrfinancial.com, or give us a call at 866-771-8901.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.